All right, good afternoon, everybody. What's up? What's up? What's going on, everyone? Wacky day today, huh? Really weird day. But let's talk about it in today's meeting. So let's get started. Should be on YouTube and the virtual trading floor. And I'm an associate member of T3 Trading Group, which is an SEC registered broker dealer and member of FINRA SIPC. All of my trades are placed through T3 Trading Group. You should carefully consider whether trading is suitable for you in light of your own financial condition. There's the position disclosure. It's pretty much the same. I liquidated my Unity position into that up move this afternoon. There's a few other names I day traded today and got into and out of. But let's pop over to some charts. Yeah, so what a weird day today was. I'm really struggling to actually wrap my head around this one. Usually I think that most of the time, through a combination of logic and technical analysis, you can get a good understanding of why markets behaved the way that they have. But I'm trying to wrap my head around this one, and I'm struggling to do so. So maybe some of you guys can help. So here at the end of the day, we got the S&P down 0.5%, the NASDAQ green small, flat to green, and the IWM down over 2%. It was a total bloodbath in the Russell. The Dow, which I usually don't ever look at, down 0.5%, so we can go back to not looking at it. But the difference between the Qs and the Russell is really impressive. It's a really big spread between the performance of those two indices today, and it's on the backs of TLT, quick Treasury ETF. This is the one. This is my go-to, just to eyeball, to have an idea what interest rates are doing. Down 1.5%. So it's a big move. And the dollar, just using the UUP ETF, up 0.5%. So that's a pretty big move. So interest rates up, dollar up, tends to provide a tightening impulse. I'm really surprised that tech held up as well as it did. The IWM was incredibly weak. I almost feel like that's where the whole market should be, though, given what interest rates and the dollar did today. And if you look at ARK, which is the ETF that I like to look at just for like a quick glance into what growth is doing, ARK's up 0.9%. And I feel like this is what should be most destroyed on moves in interest rates and the dollar like we actually had today. So I'm kind of scratching my head a little bit. If it was just your Apple, Amazon, Google that held the Qs up, we've seen that before, and I could say, well, maybe the market's just viewing it as a little bit of a flight to safety because Apple has more money than most countries do, and in an environment where interest rates are moving so quickly to the upside, which can destabilize the market a little bit, your Apple and some of these big tech stocks can be viewed as safety plays, which then really can enable the Qs to hold in. But ARK and some of these growth names being up as much as they are with a kind of a tightening impulse from interest rates and the dollar, I really struggle to wrap my head around it. And I kept kind of saying throughout the day, even looking at my portfolio swing positions, I had 17 positions coming into the day. I've got 16 positions now. I feel like, not that I'm complaining, I feel like I should be down more money on my swing positions than I am, and I feel like I should have a lot more names that are red than I do. I've got more stocks that I swung that are green than are red at the end of the day today, by a little bit. And I'd be curious when is the breadth numbers, what the breadth numbers actually look like, because they should be pretty bad today. And while I haven't seen them, I would think that they're actually not as bad as they, air quotes, should be, given this move in the IWM, which is just a really brutal move. 5-minute chart of the SPYs of the S&P, very boring and choppy, which kind of met our expectations, right? If you remember what we discussed in the morning meeting today, was that the S&P and the NASDAQ were still a little bit extended on the daily chart, so they're still going through a time and price correction of this really big move that we had over the course of 5 days or so, from August 25th through August 31st, really. So some further time and price correction needed in the S&P, needed in the Qs. The IWM has been relatively weak, which we never want to see because I feel like it's more representative of the average stock that you look at in the market. But the IWM was gapping down kind of into the equilibrium area. So the most bullish thing I could think of today actually would have been the S&P and the Nasdaq giving a rest day, more or less like they did. But with the IWM actually showing relative strength, it turned out to be the complete opposite. The S&P is down on the day. It continued its price time correction, but as a percentage of this up move that we saw over the course of 5 days, where the SPY went from 435 on August 25th to Friday's high of 454. I mean, this pullback is super small. We're not even down to our broader equilibrium area between the 8 and 21 EMA yet. Q's kind of same deal, and Q's obviously held in really well. But this IWM candle is really bad. And even during the day today, again, trying to figure out where this weakness in the Russell is coming from. It's like, all right, banks had a weaker day today. XLF closed down 1%, so not nearly as bad as the IWM. KRE, though, which is the regional bank ETF, which has got much more representation in the IWM, the KRE is down 2.25%, so that's actually a little bit worse than the IWM is, or somewhat in line with the IWM performance. Utilities had a really weak day. Not that I almost never even really look at utilities and never trade them just because they're boring and slow. IWM is down 1.4%. But if you look at, like, I guess an XBI is down 2%. Some of these names should have been killed. When the IWM is down over 2%, usually I feel like at the end of the day, I'm looking at an XBI ETF that's down 3 to 6%. I'm looking at growth stocks. If the IWM is down 2%, I'm looking at growth stocks that are down, 5 to 8% a lot of the time. And yeah, you can find some examples out there. This Penn, I don't even know if you want to argue that this is a growth stock anymore, but Penn got absolutely slaughtered. It seemed like some of the casino names in general were also really weak. I was actually asking myself into the close if Penn these days trades more with a DKNG or if it trades more with like a Wynn Resorts or an MGM now that they spun off part of their business back to David Portnoy. And honestly, I don't know the answer to that, but it was super weak. But other growth names, I mean, I liquidated my Unity position today because it hit my target on the trade, and the stock closed up 4% on the day, which I just Roblox, another one, up 2.25% today. What did Roku do? Roku, yeah, massive day. Roku broke that 81 we had been looking at last week. I think it was 81. Yeah, Roku up 2.5% on the day. Palantir, even Palantir, being flat on the day. You kind of would think that some of these names would get destroyed, and most of them held in really well. I mean, Tesla was one of the biggest performers that was out there. Tesla did have a little bit of news this morning on some of their government grants that they're getting for their charging stations. I don't know if that helped the stock. I thought about actually putting Tesla on the long watch list for today. I just didn't like Friday's candle. Dimitri giving us the breadth numbers, which is in fact bad. So I guess the Nasdaq was pretty bad also, considering that it closed flat to green. So maybe I'm just lucky with the positions that I'm in, happening to show some broader relative strength, and my universe wasn't big enough to see where the bigger weakness was. But I'm really surprised that some of these names held in the way they did. This Coursera, which is a little bit of a slower growth stock that I'm in. I took a big sale in this thing today. I've been in this for a while. This is another one of almost 3 percentage points on the day. I'm just, again, really kind of surprised and impressed on the way that some of these names held in. XLE did not close well, but still closed positive also. So Energy's up 0.5%. XLE, OAH closed up 0.8%. I mean, they gave these little shooting star candles here, but Energy got really extended. This was a trade from late last week that we had discussed. Going long Energy was the sector that I liked the most late last week. I thought it was the most, the most what's the word I'm looking for? Most productive chart, I guess, that was out there of most of the sectors last week, that they made the entry a little bit difficult. This morning we discussed that into this gap up, it's really more of a take profit area. Just that's a large extension on XLE versus that 8 and 21 EMA compared to how it typically trades. Obviously got helped out by the Saudi Arabia / Russia oil cut news that hit this morning, which helped give the price of oil just kind of a general boost. But yeah, real strange day overall. For myself, again, I liquidated my Unity position. I traded a little bit of this Amazon. I made a few dollars in it. I traded a little bit of that TNA, just day trading it off of the IWM into that first major dip. We caught off this long off this 5-minute extension hammer here at 950 for that snapback trade, which was decent. It looked like it maybe wanted to give a double bottom at one point, but that failed, and this thing closed on complete lows. And then I traded this GDC. I don't know. I tend to not do well with these types of names. These like low float news buy names. I probably shouldn't trade them. I'm sure if I were to look back career-wise, I'm down on them over the course of my career. Though every once in a while you get like a VFS that I did really, really well with that, makes you kind of want to go after them a little bit. But yeah, I was up a bunch in this thing at one point off the open. I had pretty much stopped myself out through 365, actually, based on the pre-market move on the way down. I kept the core position, some very small core position compared to what I originally had, and I was trying to trade it around it, and then I made a couple mistakes in this that I was really unhappy with myself about, and I did something that I always preach that a trader should never do. I turned a winner into a loser, which was just stupid. And I ended up liquidating on the break of this consolidation here. This red bar is me selling when I added back in. So I turned a winner into a loser in a stupid stock that I know nothing about and don't believe in, where I was just trading a headline in a low float name to see if I could get a squeeze. It's really not where my edge is, even though I can make a few bucks in them here and there if I'm disciplined. I can't be undisciplined, which is exactly what I was. Made some mistakes, turned a winner into a loser. Just kind of trading 101 there, and I violated it. I guess the long weekend got into my head a little bit, and I made some mistakes, but it just is what it is. It happens. I need to just make sure I don't repeat my mistakes. Nothing wrong with making mistakes. There's a big problem with repeating mistakes, which at this point, if I'm making any mistakes, it's a mistake I've made in the past, so it counts as a repeat mistake. So I deserve to beat myself up on it a little bit. But outside of that, I mean, relatively uneventful day, because I had a game plan coming into today's trading session to be conservative, just based on the kind of continued smaller extension in the SPYs and the Qs, and coming back from a holiday weekend. This week and last week tend to be two of the slowest weeks of the year, so I just saw no real reason to push it, which maybe is why I overtraded that GDC a little bit and turned a winner into a loser, which again is just a mistake. I need to be able to do better than that. I can't be making mistakes like that after as long as I've been trading. But everything else was fine. I made a few bucks day trading Amazon. Got to liquidate my Unity position. I traded that TNA really well, and kind of managed my swing position. So more or less followed my game plan. And I guess that's pretty much it. I don't really have too much for you guys today, given this price action, outside of noting that I thought today was a really bizarre trading session, just with how the market traded, where we saw relative strength and relative weakness, considering what interest rates in the dollar were actually doing. This dollar move is starting to become a concern. We really broke out, just looking at this UUP ETF, we really broke out in August. And there's not really much to the left until you get back to that peak that helped mark the October S&P low. So we got to continue to maintain an eye on this dollar, because if the rate of increase continues the way that it has since the July low, it's starting to become a little bit of an issue. And same deal with TLT. This 2-day move in this TLT ETF with interest rates moving up between Friday and today is not great. The snap back off this low was actually bigger than I expected it to be, off that August 21st low, and we were last looking at some real extension and looking for a price correction up. we got that initial price correction up, but it was this breakout back through like 96 or so that was impressive. But now we've totally fell back down off that area. So yeah, that's all I got. Again, not too much for today, so I'm happy to answer any questions anybody might have. From Dave S is the first thing I'm seeing here. Did a little sleuthing. Is that a word? I might be expanding my vocabulary if that's a word. I gotta get out the old dictionary to try and see what the deal was today. So thank you. Careful investigation into a crime or mystery. The truth behind Joe's predicament is uncovered only after much sleuthing. Wow, that's exciting. So I did a little sleuthing today to try and see what the deal was today. One thing that might be part of the story today was looking at the sectors. XLK and XLE are great today, but other than that, it was actually very poor. Yeah. XLY was flat, but XLU, which I pointed out, XLI, which I did not point out. How did this XLI got smoked? I don't really look at these utilities and industrials that much. 1.7%, still not as much as the IWM. XLF, which we pointed out, not as bad as the IWM, but KRE was really weak. And XLV, yeah, healthcare down 1%, also less than the IWM. I think that XLU is the worst of the bunch, and some real selling happened there. Even though I can see all of this, I don't see anything that explains it other than some folks coming back from the summer vacation and deciding to reposition. Yeah, I mean, we more or less entered a new month. I know Friday was the first trading session of the new month. September, like I said, tends to be seasonally weak, so we'll see how we get through September. My biggest expectation, even though it does not act for fun trading right now, and I've been saying this for over a week, is that the market finds a broader range that could last the whole month of September, with a low probability of a major breakdown. Like, I think there's a low probability of a really fast downside move, and we just need to keep that in mind, because while it's low probability, I think if the downside move happens, it's going to happen fast and furious. And I think that the highest probability is really going to be broadly sideways action, with also a lower probability situation of an upside grind where we clear 460. I think we're going to make new highs in the year. It happens into the end of the year at this point, but I don't like making calls that are that big picture. No idea what this market environment's going to look like come November, December. So take it one day, 1 week at a time. If you like Fast and Furious, I would not have high expectations, especially for this week. But yeah, Dave, I mean, even when we scroll through most of those index ETFs, you don't really see any of them that are down as much or worse than the IWM itself actually is. From Ben. My question today is about risk-reward assessment, specifically as it relates to timeframes. I recall from your game planning video that for a trade to be considered worth it, you want to be able to make at least 3 to 1 on your risk. Okay, let's put an asterisk next to that. Is it important for the stock to be able to give you that 3 to 1 on the same time frame that your trade is placed? For example, I bought Oracle today at 940 with about 80 cents of planned risk after covering my risk. So Oracle, that was one of the ones that we discussed in the morning meeting, and Oracle traded pretty well today. Initial downtick, but once it found its 80 MA on that pullback, it traded pretty well and was able to break out. After covering my risk, I would need to sell the other half at 126.60 or better to make 3 to 1. And ideally, we can't make more than 3 to 1. Ideally, we want to make even more than 3 to 1. It's very unlikely to get this move on the 5-minute, which is the chart I use to place this trade. Is this a bad trade or a decent trade that will just take some time to work? Yeah. So one of the things that you want to assess for yourself is what is the time frame on which you actually like to trade. Are you willing to keep positions overnight? The answer for me to that question is 100% yes. I think I spoke about it in an afternoon meeting last week. The longer that I've been in the business, the longer my hold time has become on trades. And I, over the years, even though I started as a pure day trader, I view pure day trading as reward limiting. So what I like to do, I mean, sure, on a pure day trading perspective, you're trying to get 3 to 1. With the way Oracle trades, taking 80 cents worth of risk on Oracle to try to get 3x that intraday is probably going to be difficult. I think Oracle has improved as a trading vehicle. I've noted that a couple of times since April, when this thing really broke out and had a big move. For most of my career, Oracle has not been a good trading stock. A lot of the, and we talked about it real briefly in the morning meeting, a lot of the real legacy tech bubble late 90s stocks, Intel and Cisco and Oracle and IBM, they just don't move really well anymore all these years later. And Oracle, I think, had some AI news or something like that back in April or May that kind of changed the way the stock moves. So that's why I said we should bring it back on the radar. But all the same, if you look at how Oracle tends to trade, 80 cents is a lot of risk if you're just trying to do something intraday. But look at the daily chart. You can't enter that position and think intraday. So a lot of what I like to do is I like to find intraday trading setups where I'm putting on risk that's on a 5 or 15-minute chart, but have that be in the direction of the daily chart. And then if I can get a good close, it becomes a swing position where the intraday profit cushion I have helps to mitigate the overnight risk of an adverse situation happening overnight that causes the entire market or that stock itself to actually gap down, but then look for the daily chart reward. What's the daily chart reward on Oracle? What levels even still exist in this thing? Like, okay, you got one potential target around 127.50 from this June peak where it went a little bit parabolic past that news and past that earnings report. That's one level. Outside of that, I mean, my chart doesn't go back far enough. You probably got to go back to, I mean, I don't know. In 1999 was Oracle higher than this? You got nothing to the left. Is basically the point. So what's your reward limit on this? In theory, it's unlimited, right? Because the trend is your friend and the stock is broken out and there's nothing to the left. So that's how I think you want to be thinking about this. And if that's your thought process, then all of a sudden 80 cents risk is not a problem. Whereas on a pure intraday basis, if you're like, no matter what, I'm closing out my positions by the end of the day, then I think Oracle is way too much risk. But again, that's why I try to have a bigger picture approach. And if you're trading on a smaller time frame, you're taking 80 cents worth of risk. That's a lot on a 5-minute chart in this stock, but it's not compared to the daily chart. And that little bit of extra space that you're utilizing with an appropriate stop loss that's based on the technicals means that you're not getting out of your position on the downside via like a shakeout. You know that if you're getting out of your position on the downside, that your idea itself was wrong. And that's also how I prefer to trade at this point. I trade in a way for my ideas to be right and wrong. As a trader, every trader needs to know and learn themselves. The people that are out there, and there's a couple people in this room who do it very successfully, like Judy is an example, if Judy is listening, are just kind of these momentum hyper scalpers on really small time frames. I've learned that for myself personally, I struggle to trade that way because I'm getting stopped out of positions because I'm keeping my risk so tight because I'm just trying to be involved on that pure momentum where I don't know that my idea was wrong. And if I don't know that my idea was wrong, that's when I tend to come in and fight the stock. I get stopped out, I rebuy it, I get stopped out, I rebuy it, I start churning, and I don't do myself any favors that way. So for me, for who I am as a trader, I would prefer to give Oracle 80 cents worth of space based on how that daily chart looks like, get the close that you got today, keep that position overnight, and see what this thing looks like as I continue to manage the position, trade around a core for cash flow, which is also something we spent a lot of time talking about over the course of the last month or so in afternoon meetings, how to trade around a core for cash flow, and see what it can do just to continue to pay me. But for someone else, like a Judy as an example, who I guess isn't listening or she would have said something by now, You know, she feels more comfortable on that intraday time frame, even though I know she will keep some things overnight, and can scalp really, really well, and doesn't mind just, you know, stopping herself out, you know, when it moves, depending on the stock, obviously 5-10 cents against her, even if it then, you know, snaps right back up and continues. That's not the trades that she's looking for. So, you know, a big part about trading broadly, and I think this is one of the things I'm going to talk about when I'm giving that conference in Las Vegas that I'm doing later this month. It's really just about knowing yourself. Like, I'm not in a position to, you know, come onto the VTF and tell anyone that their approach is right or wrong if it makes them money. I mean, it is right inherently if it's right, if it makes them money, even if it's not an approach that I myself could implement successfully, just kind of based on who I am and how my brain works. That's something that we all need to figure out. And circling all this back, that's what makes our team here so great, is that we've got so many different traders with so many different approaches, different products, different edges, and we can learn, you know, from one another, provided that we all communicate well into our virtual trading floor. And that's why communication is so important for everyone. It's important for newer people and people that are really experienced also. So appreciate the question, Ben. Solid. Scrolling through here, just seeing Morgan saying, I'm pretty sure that NVIDIA called out Oracle back on their spring conference call. All right, yep. And with the launch of DGX Cloud through our partnership with Microsoft Azure, Google Cloud, and Oracle Cloud Infrastructure, we deliver the promise of NVIDIA DGX to customers from the cloud. Thank you, Morgan. Joanna asking if we like oil. I do like oil. Broadly, I think that a new entry here is very difficult. I think it needs to reset up. I think that oil and I don't really like to trade the commodity ETFs a lot. I prefer to really trade the stocks that are based off the commodities and keep an eye on the commodity itself. So I know that we've had a strong eye on the upside for XLE and OIH for quite some time now, probably since July, and it has not disappointed and gave us another leg up here just over the course of the last few trading sessions. I also would not chase oil here or XLE or any of those stocks. A lot of these commodities do tend to be a little bit more mean reverting, and therefore their stocks do as well. So I'd be a little bit cautious on new entries right now. It needs to reset up after such a big move. But broadly, big picture, yeah, I'm bullish on oil still. How do you see how many shares the stock traded in a day? Well, you can see it on your level 1. I mean, you can just see Apple today traded 44.7 million shares. It's on your level 1, or you could just look at a daily chart, and you could just a lot of what I like to do just to get an idea of average volume that something trades is I just look at the daily chart and I just kind of take my yellow line here and I just kind of go somewhere around where it usually peaks out, and I'll say, oh, you know, Apple usually trades around 48 million shares. It's just how I'll eyeball it really quick. From Ben, following up on his Oracle, I was able to keep half of it. I was definitely looking to swing it if it closed well, and it closed well. Also, I know that we have to look for larger time frames for the bigger reward. I was just wondering if a trade was supposed to reach that 3-to-1 minimum more quickly as a way of grading my execution. Yeah, I mean, I think I'd just say 3-to-1 is like a very general thing in that class that you saw. Like, if you don't think you can make 3-to-1 on the trade, it's probably not worth taking. But another thing that you'll hear me say very regularly is that I really don't look at my trading in terms of risk-reward multiples. The way I view it is that if I'm trading correctly and I'm looking for that small time frame risk for big time frame reward, that the risk-reward multiple will occur naturally. So I don't need to be planning out my 50 cents risk here for $1.50 reward. It really never kind of goes through my thought process, especially on with trend trades. Maybe to some degree on counter trend trades, I'll take a quick look and I'll be like, well, is the low, like with the IWM trade today at lows, is my entry point versus my stop loss at lows at least 1-to-1 on my entry point versus where the ADMA is at that time. I'll take a quick look at that, and if the answer is yes, then I'll have an interest in trading it, and if the answer is no, then there's no way that I'm doing that. So thanks again, Ben. From Rex. How do you overcome staying in the trade as long as you could? I was swinging Chevron from Friday. On Monday, Chevron came out with some bad news. I assume you mean yesterday when the market was closed, and I assume you're talking about their strike in Australia, which, if you're talking about the strike in Australia, you also need to analyze how significant that actually is for the company as a whole. And I think a 2-week strike in Australia is not going to be really moving the needle for a company like Chevron. Anyway, so I stayed in the trade. I took some off around 167 at the open. I was planning to add back if it pulls back at 10:30. At 10:30, it looks like Chevron was pulling back a little bit too much, so I didn't add. Add back the stock. I sold at 167, but the daily was a little bit extended. Also, broke out at 164 area. Could you talk about what to consider when adding back stock? Would you consider intraday price action to add back stock? Yeah, I really think that you're actually overanalyzing this one in a pretty big way. I think you overanalyze the news. I think that the move in the price of oil actually is significantly more important than that Australia strike for Chevron. I don't think I would have sold stock just at 167 off the open specifically because of that move. I'd be selling there because it's my preset game plan. So I think that everything that you're talking about, which is, I kind of broadly think is an over analysis, can be avoided by you just following the game plan that you set for yourself originally on the trade. If you said to me, hey, Derrick, my game plan was I need to sell some into extension, and at 167, Chevron's super extended on every time frame. It's getting really extended on the daily chart. It's really extended on the 5-minute chart. So I'm gonna sell some stock there, and then I'm gonna look to rebuy it back incrementally, or I'm gonna buy it back when it gets to equilibrium on a 5-minute chart or equilibrium on a 15-minute chart. That would be a good game plan, and then you just follow it. Not kind of this over-analysis of, well, I'm going to sell some here off the open because this news looked bad, and then I'm going to rebuy it, but I'm not going to rebuy it because the pullback is too deep. I just think that it's way too much complication into the game plan itself, and that you should keep it a little bit simpler than that, to be totally honest. So I hope that helps. If my reason for selling is extension, then I will be buying back into equilibrium as a rule, because then it's no longer extended and I can keep the difference. Or if I'm selling at that spot because it is just a game plan to sell stock incrementally, then does my game plan say that I should also be buying back that stock incrementally on the way down for like a cash flow trade like we've spoken about, in which case that's what I should do? Or does my game plan say I'm just putting this money 100% in my pocket, I'm implementing a trailing stop system, I got extension here so I'm booking it, and I'm not looking to rebuy anything? In which case, that's what you should do. I don't think that you should be over-analyzing the pullback on that time frame when your trade was a swing trade and it's a little bit bigger picture than that. So I hope that helps. ZS came all the way back. Josh was right. Josh was right. Josh said it wasn't enough. I thought that earnings report looked fantastic. All right, cool. Looks like we got through all the questions in the VT. Oh, there's Lath. It's got one more for me. I'll also log into the YouTube at the same time to see if there's anything in there. From Lath, do you ever take a smaller time frame trade and then decide that you actually want to trail it on a higher time frame? And if so, how do you manage the position? So again, I think that good game planning should dictate that you are knowing what you're doing on the trade before you even enter the trade. So what you're already telling me is a violation of that. You're saying, hey, I took a trade with a game plan and now I decided I wanted to change my game plan mid-trade. So I automatically don't like that. What I will do, which sort of is in line with your question, but also doesn't violate my rule of having a game plan and sticking to it, is I will take trades on a small time frame, and then in the game plan itself, is kind of what Ben was talking about. I want to swing it if it closes well, and then the next part of the game plan is if I am swinging it, then I am going to trail it on the daily chart. So that's a lot of what I do, but it's built into the game plan. It's still a series of if-then statements. Again, just kind of going back to both your question there, Laith, and to what Rex just said, and this is also something I'm planning on speaking about at the Market Mind Summit in Las Vegas, because I was just thinking about it more and more over the weekend, and I started to put the presentation together. The key, and I say this all the time, and it's the most obvious statement ever, but it's so important, and I really think it gets lost on traders. The key to consistent profitability is to have a consistent approach to markets. You cannot have a consistent approach to markets if you are not approaching the markets consistently, and that requires rules that enable you to actually do that, right? The only way that you can have a consistent approach to markets is if everything that you're doing is governed based on rules. And a game plan is a series of rules for a specific trade that you've found. So it's like a multi-step process to consistency. Like, what do you want? Everyone's going to say, I want to be a consistently profitable trader, right? Somebody who is graduating college next week, who's never traded before, and did a little bit of research, and if I'm interviewing that person and I say, what's your goal? It's going to be, well, I want to be a consistently profitable trader. Okay, great. Everybody wants to be a consistently profitable trader. How do you do that? Do you expect to be consistently profitable if you're coming in willy-nilly and trading in a different way every day? Today you're a day trader, tomorrow you're a swing trader, and the next day you're a stat arb trader, you're pairs trader, algo trader. You're doing something different every day. You're never going to achieve consistent results. You're never going to be consistently profitable. But yet, every approach that I just briefly mentioned throughout the course of this afternoon meeting, we probably have at least one person on the team who's implementing it successfully. But they have certain things in common, and whatever that approach is, I don't care what your approach is, to be honest. I am open about what mine is, and I'm probably a major learning source for a lot of people that's here in the VTF. You need to just figure out a system of rules to actually be able to implement it consistently. Because if you're changing your game plans on the fly, if you're deciding like, oh, I don't think this looks good anymore, and I'm getting out or whatever, you're never gonna have consistent results. Which is why I tell people, show me a trade that I'm already in that all of a sudden looks like garbage. Should I hit out right now to save myself some money? Or should I lose more P&L by following the game plan that I created for myself and keeping my original stop? That's what I'm going to do every time. I would rather lose more money on something that I'm already in, that I'm looking at that doesn't feel like, I don't think is going well, I don't think it looks right anymore. I would rather lose more money on that trade than save myself some money by hitting out right now. Because if I hit out right now, I'm no longer a consistent trader. And there's just a very slippery slope to, well, just on this one trade, I'm going to save myself a few dollars and hit out a little bit early because it looks like crap, to getting in your own head and having bad trading psychology and finding one reason why any single trade you're possibly looking at could fail and liquidating everything and having no consistency at all with your approach. I was asking because, follow up from Laith here, I was asking because if there is a nice trade on both the 15 and the hourly and one can validate the other, so both are part of the game plan, just thinking about your Microsoft trade, which you held for years, and was just wondering if that probably started as a lower time frame trade. It did. It started as a breakout on, well, all my breakouts are stemmed off daily chart resistance, but I executed it off a 5-minute chart with like a, probably like an ignition bar low stop loss, and then it closed well, and the next thing I knew I was swinging it on the weekly chart, and that was just my game plan. I was swinging on the weekly chart, and Microsoft on the weekly chart, if you know what my trailing rules are, it's Chevron. Microsoft on this weekly chart never broke my weekly trailing rules from the breakout in 2014. I think it was 2014. It might have been 2015. wherever that breakout was, all the way until COVID, which was just awesome. So it was just a sick hold, and I was like, all right, well, my game plan says I'm trailing it on the weekly, based on pivot low, ADMA catch up, new high, my 3 rules for trailing, which I go over in detail in that class, and all right, I'm in from, I think I was in from like 40 or something like that, and got stopped out on the way down here at like, I don't know, 160 something, 170 maybe, which still means I gave back a lot because that high was 190. But the whole thing about trailing strategies is that you will by definition never exit a position at highs, which you need to be fine with, because eventually, if the trend is strong, your stop loss becomes higher than where you would have liquidated the position at a previous point in time, which is just a great feeling when you find yourself in that spot. Over to the YouTube channel here, Kevin G. Any thoughts on Tesla? Was happy to jump into that at 250 long after the opening drive. Yeah, I like Tesla's relative strength today. We saw it early. Was phenomenal. The only trade I called out in this thing, I did not call it out with a lot of conviction because I didn't trust the market, was the pullback into the ADMA off this pivot low here as a trade. I liked that news that hit pre-market, but I didn't know enough about the Tesla story to know if it was really new or priced into the market enough. And I didn't like the daily chart after Friday. I thought the pullback was too deep, so I didn't put it on my list at all. But when we saw that incredible strength come in, this was a good opportunity to get some stock. So I'm glad you were able to do well with it. Yeah, we'll see. On the daily chart, and I agree with you, that's a great initial comeback, but this is just an inside day. So for tomorrow, I'd watch today's high, and really this thing needs to recapture above, needs to recapture 260. So we'll see. I was a big picture bear on this thing for so long, and I'm actually finally like a little bit less bearish on this name, which if anybody's been on the team for years, you should know that adjustment is solid for me. But you're allowed to adjust your thesis as new evidence comes around. I certainly did on Uber. Uber is another one that I was just super bearish on this stock. I remember shorting it back here off that IPO and doing really, really well with it for a period of time. And then more recently, I started to flip bullish on it. I forget where. Somewhere over the course of the last year or so. I think that the picture's really changed for Uber. From Robert, which conference am I training? No, I'm not doing, what's it called? The Market Mind Summit. Here's the link. Actually, I'm not allowed, I don't think I'm allowed to post a link into YouTube. MarketMindsSummit.com. MarketMindsSummit.com. There it is. Whatever. Check it out. Be there or be square. Put it here in the VTF too, in case somebody wants to come. Alright, gang. Well, it's almost 5 o'clock. Looks like I got through all the questions. I didn't have too much to talk about today. A little annoyed at myself for how I traded that one position. Can't turn winners into losers. It's like literally trading 101, and I violated that today. Otherwise, my day was fine. Not really exciting on the upside or the downside. But again, tends to be a really slow week, so don't push at midday if there's not a lot of opportunity out there. That's right now is going to be something I probably continue to talk about during the week. And yeah, that's it. One day at a time. So have a great night, everybody. I will see you all tomorrow.